The Psychology of Investing. Chapter 13. The Influence of Personality on Investing. Before we talk about investing behavior, it helps to separate two kinds of anxiety. Trait anxiety is a more stable tendency to worry across many situations, while temporary nervousness is a short-term reaction to a specific event, like a market drop or a scary headline. Both can feel intense in the moment, but they do not mean the same thing. Someone with low everyday anxiety may still feel rattled during a crash, and someone with high trait anxiety may feel uneasy even during normal market fluctuations. That distinction matters because one points to a passing stress response, while the other may shape your investing decisions more consistently. If you mistake a stable pattern for a temporary mood, you may build the wrong kind of portfolio for yourself. Investing always asks us to live with uncertainty. Returns are never guaranteed, and even a well-diversified portfolio will decline from time to time. Risk tolerance is not just about what return you want. It is about how much uncertainty you can handle without being pushed into bad decisions. People with higher trait anxiety often have lower risk tolerance because losses feel more threatening and more emotionally intense. That does not mean they are weak or irrational. It means their emotional capacity for uncertainty may be narrower, so the same market dip feels far more alarming to them than it does to someone else. When trait anxiety is high, it often shows up in behavior that quietly works against long-term goals. Some people avoid investing altogether because the uncertainty feels too uncomfortable. Others invest, but choose a portfolio so conservative that it may not support their future needs. Anxiety can also lead to checking accounts constantly, which usually increases stress rather than reducing it. Negative headlines may feel especially urgent, and normal market declines can trigger quick selling. These are common patterns, not personal flaws, but they are important to recognize because they can turn temporary discomfort into lasting financial damage. Caution with money can be a real strength. Careful investors often avoid speculation, ask good questions, and think seriously about risk before acting. The problem begins when a decision is driven less by a sound plan and more by a need for immediate emotional relief. Selling after a drop may feel better for a moment, but relief is not the same as good risk management. A planned, cautious response might involve rebalancing, reviewing your allocation, or simply waiting. Fear-driven moves usually break the plan, even when the plan was sensible just a few days earlier. A simple self-check can reveal more than your intentions ever will. Start by noticing your usual level of worry in daily life, not just during market turmoil. Then pay attention to how you react when uncertainty shows up, especially when prices fall or headlines turn negative. Your past behavior is especially useful here. Did you stop contributing, sell quickly, or obsessively monitor your accounts under stress? Those reactions often reveal your true risk tolerance better than what you say during calm periods. The key question is whether your current portfolio fits your actual comfort level, not the version of yourself you wish you were. The goal is not to become fearless. It is to build an investing strategy that you can realistically stick with, even when markets get uncomfortable. That often means separating thoughtful caution from panic, using diversified funds to reduce decision fatigue, and choosing a lower volatility mix if big swings reliably push you toward poor choices. For some investors, more bonds and fewer moving parts create a healthier long-term setup. Automation can help too, because regular contributions continue without requiring a fresh emotional decision each month. The best strategy is not the most aggressive one. It is the one that still works when your emotions are under pressure. Maria offers a good example of healthy adjustment. After a modest 5% market decline, she feels intense worry and notices an immediate urge to do something drastic. Instead of quitting investing or selling everything, she pauses long enough to recognize that anxiety is shaping her reaction. She reviews her plan and decides the portfolio is simply more volatile than she can comfortably handle. So she shifts part of her money into bonds, keeps some exposure to growth, and stays invested. That is not failure or retreat. It is a better match between her personality and her strategy. Several mistakes become more likely when anxiety is not recognized ahead of time. One is confusing trait anxiety with normal nerves, and assuming everyone feels this distressed all the time. Another is treating low risk tolerance as a weakness, when it is really just an important piece of self-knowledge. Some people respond by avoiding investing entirely, while others copy someone else's risk level and end up overwhelmed when markets fall. A final mistake is waiting until a crisis to decide how you want to behave. Planning works best before emotions surge, not in the middle of them. To turn this into something practical, think about a recent money worry and walk through it carefully. What exactly triggered the worry? A market drop, a headline, a personal expense, or something else? How did you respond in the moment? And was that response based on your plan or mostly on discomfort? Then ask what you would want to do differently the next time the same kind of stress appears. The final step is the most useful one. Write a simple rule for future market pressure, such as waiting a week before making changes or reviewing monthly instead of daily. A written rule can protect you when emotions start telling you to act fast. Anxiety can make investors pull back too much, but another personality trait can push in the opposite direction. Extraversion often brings energy, sociability, and a desire for stimulation, all of which are strengths in many parts of life. In investing, though, those same qualities can create a stronger urge to act. Trading feels active, engaging, and responsive, especially compared with the quieter discipline of waiting. For a highly extroverted investor, doing nothing can feel unproductive even when it is the better choice. That is one reason extraversion can be linked to more frequent trading than a strategy actually requires. Overtrading does not just mean trading a lot in absolute terms. It means trading more often than your strategy truly calls for. In many cases, the act of trading becomes rewarding in itself, separate from whether the decision improves long-term results. That is important because a person can be smart, informed, and still fall into this pattern. More trades do not automatically mean better judgment, and in practice, they often lead to weaker outcomes. So overtrading is best understood as a behavioral tendency, not simply a knowledge problem. Frequent trading can feel good for reasons that have very little to do with investment quality. It offers excitement, a sense of action, and the feeling that you are staying on top of events. It also creates quick responses to news and price moves, which can feel satisfying even when the information is mostly noise. For social people, trades create stories to tell and opinions to exchange, and a successful trade may bring praise or validation from others. The reward arrives immediately, long before you know whether the decision was actually wise. That emotional payoff is what makes restraint especially difficult. Markets do not reliably reward activity for its own sake. Every trade carries friction, even when the cost seems small. Fees can accumulate, bid-ask spreads quietly reduce returns, and short-term taxes can take a larger bite than long-term tax treatment would. Just as important, frequent traders are more likely to react to noise and miss timed decisions. None of these drags feels dramatic in isolation,
but repeated often enough, they can noticeably lower ending wealth.
In other words, tiny costs multiplied by many trades can do real damage over time. One reason overtrading happens so easily is that markets produce a constant stream of false urgency. A short-term price move, a dramatic headline, a hot tip, or social chatter can all feel important simply because they are loud and immediate. But attention-grabbing information is not the same as decision-improving information. Short-term noise may trigger emotion without changing the long-term value of an investment at all.
Investors who enjoy stimulation are especially vulnerable because they are often more exposed to these fast-moving signals.
Learning to separate noise from signal is one of the most valuable skills an active-minded investor can build. Overtrading usually develops as a cycle rather than a single mistake. A trade creates excitement, which draws more attention to prices, alerts, and market chatter. That added attention increases the chance of fear of missing out, especially when other people seem to be making quick gains. FOMO then leads to more unplanned trades, and those trades often weaken returns through cost, timing errors, or both. Poor results do not always stop the cycle, because the emotional rewards came earlier. That is why this pattern can repeat, even when the long-term outcome is disappointing. Priya's example makes this concrete. She started with a $10,000 portfolio and a sensible long-term plan. But constant alerts and social discussion kept pulling her back into the market. In just 1 month, she made 15 trades. By the end of the year, her portfolio had grown to $10,400, a 4% return. That may sound acceptable until you compare it with a broad index fund returning 10%, which would have brought the same starting amount to about $11,000. Priya put in more energy and more activity. The gap in Priya's results became even more painful once direct costs were included. She paid $150 in trading fees and another $120 in short-term capital gains taxes. After those costs, her net gain above the original $10,000 was only $130. That is the kind of arithmetic many active traders overlook, because the individual expenses seem manageable at the time.
But when added together, they can consume a large share of the return. A simpler buy-and-hold approach would likely have allowed Priya to keep much more of what the market actually offered. The answer is not to change your personality. The better goal is to build habits that slow unnecessary action. Automatic monthly investing helps because money goes into the market on schedule without requiring fresh excitement. Turning off price alerts reduces stimulation and lowers the number of moments that feel urgent. Reviewing your portfolio only on a fixed schedule creates boundaries around attention, and waiting several days before acting on a new idea gives emotion time to cool and better judgment time to return. These habits do not remove enthusiasm, they prevent enthusiasm from taking over the process. A simple reflection check can interrupt an impulsive trade before it happens. If a tip, headline, or social media post makes you want to act, pause and ask what information triggered the urge. Then ask why it feels so urgent, because urgency is often emotional rather than analytical. Notice what you are feeling in that moment. Excitement, fear, curiosity, envy, or fear of missing out. Finally, ask whether you would still make the same trade after a 7-day wait. If the answer changes after a week, the original impulse probably was not as strong or as thoughtful as it first seemed. The key idea here is simple. Activity is not the same as progress. Extraversion can make investing feel exciting, social, and dynamic, but good long-term results usually come from discipline rather than constant action. A short-term win does not prove skill, especially when luck can look persuasive for a while. Frequent trading often lowers returns by increasing costs and mistakes. In many cases, the better decision is the slower one. That makes self-control, not speed, the real advantage. If extraversion can create too much action, conscientiousness often supports the opposite strength, discipline. Conscientious people tend to be organized, responsible, and focused on long-term goals. In investing, that often shows up as planning before acting and maintaining good habits under pressure. They are more likely to think in terms of process rather than impulse. When markets become volatile, that structure can help them keep moving according to plan, instead of according to mood. This does not guarantee better decisions every time, but it creates conditions that support steadier behavior. Discipline matters because many expensive investing mistakes happen very quickly. Panic selling in a downturn, chasing a sudden rally, or trading on a rumor can all feel reasonable for a moment and costly later. Conscientiousness helps create space between emotion and action. That pause is often where better choices live. It allows an investor to review rules, compare the situation to the original plan, and ignore noise that does not deserve a response. In practice, this trait often protects investors less by producing brilliant predictions, and more by preventing avoidable errors. Long-term investing is usually built on ordinary habits rather than dramatic moves. Regular contributions, scheduled rebalancing, and dollar-cost averaging often do more for results than repeated attempts to outguess the market. Conscientious investors are often well suited to this because they can repeat useful behaviors even when those behaviors feel boring. That matters more than many people realize. Consistency allows compounding to work, while constant market timing interrupts it. In this sense, discipline compounds too, because each small good habit supports the next one. One of the best ways to turn discipline into something practical is to write down your plan. A written plan gives you a stable reference point when markets feel confusing or stressful. It should include your goals, your time horizon, your risk tolerance, your target allocation, and the conditions under which changes are allowed. This turns vague intentions into concrete rules. When prices move sharply, you no longer have to invent a response from scratch. You can return to the plan and ask whether anything important has actually changed. Good intentions become much more reliable when they are turned into routines. Reviewing monthly or quarterly is very different from checking constantly whenever emotions spike. Automation helps too, because contributions and reinvestment continue without requiring a fresh decision each time. A simple pause rule, such as waiting 24 hours before making a trade, can stop many impulsive moves. And during market swings, revisiting the plan provides structure. When your feelings become louder than your judgment, the less often you must rely on willpower in the moment. Maria shows what discipline looks like in practice. She invests $500 each month into a broad, low-cost index fund and reviews her progress quarterly rather than constantly. During a scary downturn, headlines turn negative and some friends move to cash. Instead of reacting to their fear, she checks her written plan and remembers that her time horizon is 20 years. Her goals have not changed, so she keeps contributing through the decline. When markets recover, she benefits not because she predicted anything, but because her process held up under pressure. Conscientiousness is helpful, but like any strength, it can go too far. Discipline becomes a problem when it hardens into rigidity. An investor may overanalyze minor details, delay reasonable decisions, or keep following outdated rules even after important facts have changed. The real goal is not perfect consistency for its own sake, It is consistent good judgment. If your time horizon, family situation, income, or goals change meaningfully, your plan may need to change too. And adapting is not a failure of discipline.
Compared with other traits, conscientiousness stands out because it supports follow-through. Openness can help you consider new ideas, and emotional stability can help you stay calm under stress. Both are useful, but conscientiousness is especially valuable because it turns intentions into repeated action. It helps investors save regularly, rebalance on schedule, pause before trading, and stick with a plan month after month. In other words, it is not just about knowing what to do. It is about actually doing it reliably. A brief self-assessment can show whether you already rely on conscientious habits or need more structure. Ask yourself whether you decide in advance, keep written reasons for major choices, and follow a review schedule. Notice whether you pause before acting on news and whether you usually follow the rules you set for yourself. Honest answers matter more than flattering ones. If you have many strong habits already, you may only need minor refinement. If not, that does not mean you are a bad investor. It means systems and routines may need to carry more of the load. A useful next step is to practice one small rule for the coming month. Choose something specific and measurable, such as checking your portfolio only once a month, or waiting 24 hours after major news before making any trade. Write the rules somewhere visible, so it does not stay abstract. Then track what actually happens, rather than how disciplined you felt. Concrete behavior gives you real feedback. The aim is not perfection. It is steady improvement through simple, repeatable changes. Another personality trait shapes investing in a very different way: openness to experience. People high in openness are often curious, imaginative, and comfortable with novelty. In investing, that can create a natural attraction to unfamiliar opportunities beyond the traditional mix of stocks, bonds, and cash. This curiosity can be useful because it encourages learning and broad thinking. But curiosity by itself is not enough. It becomes a strength only when it is paired with discipline, so interest leads to research rather than impulsive commitment. Unconventional assets, sometimes called alternative assets, sit outside the standard menu of traditional investments.
This category can include crypto, art, collectibles, peer-to-peer loans, farmland, and startup or venture investments. What these assets often have in common is that they require more judgment and more independent research than broad public markets do. They may not fit neatly into a typical portfolio, and the available information may be less standardized. That does not automatically make them bad. It just means they demand more care from the investor considering them. These assets need extra care because they are often harder to evaluate well. Reliable valuation can be difficult. Liquidity may be limited. Performance history is often shorter, and the rules governing the asset may still be changing. In that kind of uncertainty, excitement can start to feel more convincing than evidence. A compelling story or new technology may create confidence before the facts fully support it. That is why unconventional assets require stronger due diligence, not just stronger enthusiasm. Curiosity should be the beginning of investigation, not the end of it. Openness has both an upside and a danger in investing. On the positive side, it can help investors notice new trends early, think creatively, and explore ways to diversify beyond the obvious. Those are real advantages. But the same trait can also make novelty feel meaningful when it is merely new. An idea can be intellectually exciting, socially interesting, and emotionally engaging without being a good investment. The key is to separate interest from commitment. Being fascinated by an idea
is not yet a reason to put money into it. Research is what turns curiosity into a disciplined process. Before committing to an unconventional asset, ask what actually gives it value and how that value is measured. Ask who controls or manages it, how easy it would be to sell, and whether the information you are using comes from independent sources or mostly from promoters. Just as important, ask what could go wrong, not only what could go right. Hype tends to focus attention on upside and hide incentives or failure points. A thoughtful investor tries to understand both sides equally before investing $1. Guardrails allow you to explore without putting your financial foundation at risk. A balanced approach usually means building a traditional core first, then treating unconventional assets as a small satellite position, rather than the center of the portfolio. For many investors, a first allocation under 5% is a sensible limit while they are still learning. That way, curiosity has room to operate, but long-term goals remain protected. This is not about rejecting new ideas. It is about making sure experimentation does not overpower the basic job of your portfolio. Because unconventional assets can be volatile, it helps to decide your rules before you buy. Write down why you are investing, how long you expect to hold it, what would make you sell, and how much loss you can realistically tolerate. These rules matter because once prices start swinging, emotion becomes much louder. Without a written plan, investors often bounce between panic and excitement. With a plan, you have a way to respond to facts, rather than react to every price move. Pre-commitment is especially valuable when the asset itself is designed to capture attention. Reviewing on a schedule is another useful guardrail. If you check a volatile asset constantly, short-term noise can start to feel like important new information. That emotional pressure encourages second-guessing and reaction. A monthly or quarterly review schedule is usually enough to revisit the original thesis and ask whether any real facts have changed. The focus should be on the investment case, not the latest headline. Scheduled review protects your attention and keeps novelty from turning into a daily emotional roller coaster. Marina shows what healthy curiosity looks like. She becomes interested in an innovative digital token tied to carbon offsets. But instead of rushing in, she slows down and investigates. She studies how the project is structured, checks regulation and adoption concerns, and looks closely at insider control and key staff. Only after that does she invest $500, which is just 3% of her portfolio. She also sets a 2-year plan and a clear exit rule. Marina is still curious, but her curiosity is working through process instead of impulse. If an unconventional asset captures your attention, a short self-check can keep excitement from making the decision for you. Ask what key fact you still need to confirm before investing. Ask whether you could tolerate losing the entire amount and what rule would stop you from selling emotionally later. Most important, answer these questions before making any real investment, not after. Writing your answers forces a pause between attraction and action. That pause often reveals whether you are thinking carefully or simply feeling energized by novelty. The takeaway is that openness can be a genuine investing strength when it leads to learning, limits, and process. Curiosity helps you explore, but discipline determines whether exploration is useful or dangerous. Healthy skepticism matters, especially when something new feels especially exciting. Small positions, written rules, and a strong traditional core allow you to stay curious without becoming reckless. In the end, novelty should never replace evidence. The best role for openness is to expand your thinking while process protects your money. When we put these traits together, a larger principle becomes clear. Strategy should fit the investor. A plan works best when it matches the way you naturally think, feel, and behave. Money often magnifies your normal tendencies, so a poor fit creates stress and inconsistency very quickly. A strategy that looks impressive on paper may still fail if it constantly asks you to act against your own wiring. The goal is not to become a different person. It is to build a system you can follow consistently through both calm periods and difficult ones. Adapting a strategy usually means doing two things at once. First, you build around your natural strengths, such as organization, patience, or comfort with routine. Second, you reduce friction in the areas where you are most likely to slip. An organized person may do very well with written rules and scheduled reviews. A more impulsive investor may benefit from simplicity, automation, and fewer decision points. Good design does not depend on self-criticism. It depends on being realistic about where your behavior is likely to help or hurt you. You do not need a formal personality test to start this process. Honest self-observation is usually more useful than a label. Notice what happens during market drops, whether you become calm, avoidant, or reactive. Watch how much social influence affects you, and whether hype changes your confidence. Pay attention to whether research energizes you or overwhelms you, and whether routines feel supportive or restrictive. Specific observations like these are far more actionable than broad statements about who you think you are. Certain traits often come with familiar investing mistakes, and knowing the pattern helps you intervene earlier. Anxiety can lead to panic selling or taking so little risk that long-term goals suffer. Extraversion can increase overtrading by making action feel productive. Conscientiousness, despite its strengths, can drift into over-control or rigidity. Openness can create a tendency to chase novelty before enough evidence exists. None of these traits is inherently bad, but each one carries predictable risks that can be planned around. The right strategy is the one you can actually follow, not the one that sounds most sophisticated. Some investors do well with a more hands-on plan because they are patient, organized, and unlikely to overreact. Others need simpler structures because too many decisions create stress or impulsive changes. Anxious investors may stay invested more successfully with moderate risk rather than maximum growth potential. Curious investors may benefit from separating a stable core from a smaller exploration bucket. Practical fit matters more than intellectual elegance. Whatever strategy you choose, it helps to add guardrails before emotions rise. Good intentions are fragile when fear or excitement takes over, so rules and automation should do part of the work for you. Automatic transfers in purchases reduce the number of moments when you must decide from scratch. Limits on trading frequency can prevent a burst of emotion from turning into a cascade of moves. A waiting rule, even just 24 hours, creates useful distance from impulse, and a written asset allocation policy reminds you what your portfolio is supposed to look like before the market starts shouting. Sophia's story shows what adaptation can look like. She loved new industries and speculative ideas, but that curiosity had pushed her into a fragmented, high-risk portfolio with too many scattered bets. Instead of trying to suppress her personality, she redesigned the structure around it. She placed 80% of her money in a diversified global index fund and kept 20% for experimental ideas. This let her stay engaged with innovation while giving most of her portfolio a stable anchor. She kept her curiosity, but added boundaries that made it sustainable. What really made Sophia's new approach work was not just the 80-20 split. It was the guardrails she added around her behavior. she required herself to research each experimental idea for a full week before buying. She set a rule to trim experimental holdings if they rose above 30% of the total portfolio. She kept speculation inside a predefined limit and protected the diversified core as the foundation. In other words, self-awareness became useful only when it was translated into action rules. That is how personality insight turns into discipline. A good fit should be reviewed regularly, but not reactively. Personality may stay fairly stable, yet life circumstances do change, and those changes can affect what kind of strategy makes sense. Once a year, it is worth asking whether the plan still feels manageable, and whether you actually followed it as intended. It also helps to notice which rules protected you most when conditions became stressful. If your income, family responsibilities, goals, or knowledge have changed, adjustments may be appropriate. The key is to make those changes slowly and thoughtfully, rather than rewriting the plan in response to emotion. The most common mistake is copying someone else's strategy without asking whether it fits your own temperament. Other mistakes include using extreme risk to fight your personality, assuming complexity is better, relying on willpower without support systems, and failing to revisit the plan at all. The strongest strategy is usually not the flashiest one. It is the one you can follow with discipline over many years. Personal fit, simple structure, and repeatable habits often beat impressive-looking plans that collapse under stress. In investing, sustainability is a competitive advantage.